Hey, this is Jordan, and this video is being recorded on the late evening of Monday, May 23rd, 2016. And in this video, I'm going to talk about the relationship between the stock market and gold and the potential impact of the stock market's near term trend on gold and gold stocks. And starting off, let me look at the stock market by itself. And this is a weekly line chart of the NYSE, which is a larger and much more broader index than the S&P 500. And at the top, we have the percentage of stocks in the NYSE trading above the 200-day moving average. Now, the stock market could be at a critical juncture here. Now, the chart shows the 80-week moving average in blue and then the 160-week moving average, and those two are the same as the 20 and 40-month moving averages. And the price action shows that the market is below both moving averages. It recently failed at its 80-week moving average at the end of April while making a lower high. And we've highlighted the other times, or noted on the chart the other with the horizontal lines, the other times that has happened. And so if you go back to 2001, the market peaked in May. It peaked above the moving averages, but it came all the way back down below them. Then in 2002, the market actually peaked in March, and then it went down and had a little bit of a rally, so it made a lower high in May, and then it really crashed in the months after that. And then again in 2008, the market made a lower high, failed, it rallied, failed at the 80-week moving average, and then came down quite a bit. So look at those examples. We can see where the market has basically around the spring made a lower high and failed at the 80-week moving average. Look at what happened there in the last two bear markets. So it's really ominous after that, and that's the setup that we're at right now. The market had a good rally after its February low, but it peaked at the end of April, failed at the 80-week moving average, and the 80-week moving average is declining. It's not flat, it's declining and sloping downward. And so, and the market right now is also below the 160-week moving average. So when it basically failed at both and they were close together, the example of that was in March 2002. So the stock market is at a potentially ominous point here. It's very vulnerable to a decline if it does not regain those moving averages soon. It doesn't mean the market is going to decline, but what we're saying is it looks very ripe for a big decline here. Not I wouldn't say a crash, but I would say it's ripe for a big decline. I mean, you look at the seasonals, you look at the failure at the moving averages, you look at the lower high. It's all there, so it's something to keep in mind. And I'm leaning towards a bearish outcome here, but what the market needs to do soon is it needs to get above the moving averages and kind of firm up in the next month or two. If it can do that, then it would have a much better outlook for the rest of the summer. But if it kind of trades lower and just weakens over the weeks ahead and goes even lower, that would not be a good sign. It would be, even more susceptible to a decline. And so, taking where we are right now, we're going to take a step back and show the potential impact on gold, basically looking at history. And I'm showing some charts from my book. And what really matters the most, as far as how is the stock market going to impact gold, is the recent correlation between the two assets. That dictates what happens to gold if the stock market crashes or has a big decline or has a big bear market, whatever you want to call it. And this is the best example of that, and we're actually seeing similarities today between this example. And so the correlation from 96 to 2003 was negative. And of course, that was the epic bear market in precious metals, an epic bull market in the stock market. And when the stock market went into its bear market, that was a positive for precious metals because precious metals were going down while money was going into the stock market. So the correlation, when the stock market went to a bear market, the correlation between the two was negative. And so negative correlation, stock market down, that means gold goes up. Here's another example of that. 1972 into 1978, nearly 6 years, and we can see that the performance between the two flipped twice, whereas in the last chart it flipped only once. And so the stock market had a very bad bear market from 73 into 1974. Precious metals did really well. Then, as the stock market found its footing at the end of 74 and into 75, had a really good recovery. That was when gold had its infamous 45% or 46% correction from essentially $200 down to $104. But after that, the stock market had a very mild bear market where it went down about 20% for less than 18 months, but more than a year. And gold and gold stocks rebounded. And then the correlation just stopped and it basically became positive. And that is partly why, I mean, it's not the best example here, but in the early 80s, you know, we had problems in the stock market. And, you know, of course, precious metals had a big blow off, but precious metals were going up into that before that period, and the stock market was going up a little bit, so the correlation was positive. And the same thing happened into 2008. Now, even though the stock market peaked before gold, it peaked in October 2007, and gold peaked in March 2008. Just the larger correlation for the 2, 3, 4 years up to that point, the correlation was positive. Gold went up, gold stocks went up, stock market went up. So then when the stock market had its problems, the correlation was positive, so precious metals also went down. And where we are right now, the correlation has been negative. And this chart is from 2015. We haven't updated it by updating the arrows. And the question is, has the correlation flipped? I mean, it appears that gold and gold stocks have bottomed. In the stock market, I mean, if you look at the NYSE, it almost went down 20%. If you look at the S&P 500 here, it's gone sideways with a slightly bearish bias for about 18 months. So, but the setup is clear in that there has been a negative correlation. And if the stock market were to actually break a lot higher, which I don't expect, that would be negative for gold. Now, on the other hand, if the market just continues to kind of consolidate in a bearish fashion, you know, that precious metals would be able to perform well as long as the stock market isn't really pushing higher. But if the market moves lower from here and looks like it's going to go into a real bear market, that would be a major catalyst for gold and gold stocks. So generally speaking, the setup is there for precious metals to perform well, and I would say very well, if stocks enter a bear market. Now, that doesn't mean that the correlation is going to be negative every day and every week and every month. I mean, there could be those periods when the stock market goes down and you know, gold and gold stocks go down. But the general, you know, looking at a time frame as far as, you know, quarters and years, I mean, that the correlation has been negative, and we're seeing performance flip, and that's positive for precious metals. So if the S&P 500 is going to go into a bear market, if it's going to perform poorly over the next year or 18 months, precious metals are going to perform really well during that period. That's what history, based on all this, is telling us. That's all for today. Please visit my website, thedailygold.com. You can get a copy of my book at thedailygold.com/book. I also send you a report that's kind of an update to the book that kind of shows what we can expect if we are early in a new bull market, as I think we are. That's all for this video. Again, thank you so much, everyone, for tuning in, listening, and watching. I really appreciate it, and I look forward to doing another video for you in the next week or two. Thanks.